Well, I'm glad to see you guys have returned from your seaside resorts and your ski holidays. That's good. Hope you got some work done in the meantime. So I'll wish you a very happy new year to those whom I haven't said so already. And all the very best for the 2019, should I say exams? No, I won't. Right, so we are back into international bonds. Can you remember where we stopped last semester? Just to see whether I can recap for you. We did bonds. Yeah, that's a great start. What do you think we covered last semester? God, this is really bad. You obviously had a damn good holiday. Anyone remembers where I stopped the lectures? Yeah. I walked you through the procedures, yeah. I think we better backtrack a bit. I hope you're now at least up to speed on the different types of structures for issues of bonds. In particular, that most bonds are issued on a dematerialized basis. Minority, a very small minority, issued with actual bonds being printed. First one is called dematerialized, second one is called immobilized. That in both cases the bonds are traded on a fungible basis. No specific bonds are bought or sold. And even when bonds are printed, they're printed and put into a vault for the entire lifetime or tenor of the bond. Remember all that? Right, good. That bonds cannot be bought by anybody other than account holders in the clearance systems in the primary markets. That anybody who wants to buy bonds has to buy them from those account holders if they are not account holders within the system. Yeah, remember all that. We also remember doing, or trying to do, an analysis of the legal position with regard to how bonds are issued and traded. And because they are issued in the dematerialized form, I think the conclusion that we all came to is that actual bonds are not being sold or traded, and what is actually happening is that interests in the bonds, a bundle of rights, which emanates from the clearance systems under the law of the clearance system, is traded down the chain of sales together with the applicable clauses and provisions in the bond instrument itself. Where do you find those? At the back of the prospectus in relation to the bond issue and also in the subscription agreement. Got that picture clear? Great. Issue process. I think I kind of took you through some of the legal analyses of this structure, which really lead to not much of a clear conclusion, except that the accepted analysis is that what is created is a chain of contractual rights relating to the bundle of rights in relation to the bonds, which is then sold down a chain of sales, contract after contract after contract. What law controls? You start with the law controlling the clearance systems, followed by the law applicable at each stage when bonds are sold, quote-unquote bonds, are sold by a dealer, and the law applicable is the law of the place where the electronic books of the seller are located, called the Freemar rule, if you remember, right? So I hope you got all that clear, because you need to keep this in mind as we move along this semester. In terms of the bond issue process, please don't regard it as irrelevant, because there's a lot that hinges on the process, and the legal rights and liabilities do hinge at various stages of this process, starting from launch to the grant of the mandate, to launch, to signing of the bond documentation, to the closing date. Lots of things happen during that phase, and you need to know what happens when in order to analyze the legal issues that arise at each stage. I hope you're clear on all of that, because I'm going to move on today, as I said to you, to look at the documentation of bonds. I think that's what I was hoping to do today. So let's get into that. Was there anything you want to ask before I started launching into the details of bond documentation? That's a list of the documents that will be used in a bond issue. I can't remember whether I gave you this last time round, but that's what it is. Now you need to appreciate that this is why I said to you earlier that the process is important, the stages of that process is important, because these documents lock into different points in the process. You'll recall the whole thing starts with that term sheet and mandate, which is signed prior to launch without any legal obligations on either side. But post-launch, the first set of documents which come into existence are the marketing documents. Doesn't mean that the investment banks aren't marketing the bonds before the documents are signed, but the actual obligations arise when marketing documents are signed. When are they signed? Long after launch, I shouldn't say long, soon after launch, on signing date when documentation is signed. What's signed on signing date? Items 1, 2, and 3. The subscription agreement, the agreement between managers, and the draft offering circular, otherwise called the red herring. There's another set of documents which are signed some days later on closing date when the issuer receives funds from the purchasers of the bonds. And on that date, the closing date, a number of things happen. The prospectus, in the form of the listing particulars, becomes final when the stock exchange affirms that they are listing the bonds on the basis of the authorized prospectus or offering circular. So that's the next document that comes in play in final form and closing date. Then you have the actual global bond. Now remember the global bond, it's a piece of paper which represents all of the bonds which have been issued in that bond issue, signed by the issuer or the directors of the issuer, and lodged with a depository bank for the clearance systems for the benefit of the investors in the bonds. Okay, that's the global bond. And needless to say, if there's definitives being printed because it is an immobilized issue and not a dematerialized issue, definitive bonds will be printed and made available on closing date. Now, I think I added a caveat to that, saying that in fact, if US securities laws demand it, on closing date, a permanent global bond is not issued, a temporary global bond is issued for 40 days to comply with United States securities laws, at the end of which the global bond in final form will be issued. The other documents that are signed on closing date are one of two. Either a trust deed, a common law trust deed is signed, or, never together, or a fiscal agency agreement is signed. One of the two. The fiscal agency agreement is the one that's signed in the majority of cases, roughly around 60 to 65% of bond issues. A trust deed is used in a minority of issues. So that's the basic format of the documentation. I tried to do a kind of, it went wrong, so I don't think I'm going to worry about it, trying to tell you who's signing which document, but the arrows are all over the place, so I've given up on it. So don't take a photograph, it's useless, it's wrong. The arrows go in the wrong places. I'll try and see whether I can bring it next time around in better form. But let's look at each document in turn, okay? Just the way we've looked at it, right? First, let's look at the marketing document, the subscription agreement, then the agreement between managers, and so on. So let's do that first. First is the subscription agreement. Now, this is the centerpiece of the marketing documentation. It is signed by the issuer on the one side and all of the underwriters on the other. Now, who are the underwriters? Remember, they are the ones giving the promise to the issuer that they will sell the issuer's bonds in the marketplace. Those underwriters will sign that subscription agreement. Sometimes the lead manager is given powers of attorney by the underwriters to sign on their behalf, in which case the subscription agreement will be signed by the issuer and the lead manager acting on his own behalf and acting under powers of attorney for the other underwriters. Okay. What does it contain? Importantly, it contains the most important aspect of an international bond issue, and that is the promise, the legal promise of the underwriters that they will sell all of the bonds of the issuer to the agreed total amount, and by closing date, if all of those bonds have not been sold, that the underwriters will buy the unsold bonds themselves. It's a sell or buy obligation. That obligation is triggered on closing date. On closing date, the funds have got to be transferred to the borrower, come what may. If you fail to sell the bonds, you, the underwriters, that's your problem. So as the issuer is concerned, the issuer gets its money on closing date. And that's one of the key elements which drives the bond issue, the underwriter's obligation to sell the bonds to them in the markets or buy them themselves. And in a way, if you look at the commission structure, you'll see that that is, oh God, thank heavens. I thought, here we go, back to the audio-visual unit. No, it's all right. The subscription agreement will also specify the commissions to be paid to the underwriters. Now, the payment of commissions to the underwriters is required as a global sum in the subscription agreement because it's a payment by the issuer to the underwriters, usually calculated on the basis of a discount on the face value of the bonds, meaning if the bonds are being sold at 105% or are going to be sold at 105%, the issuer will get not the full 105%, but 105% less the commissions owed to the underwriters. And that's how the money is paid. It's not paid up front, it's paid up on closing date when the funds are received for the issuer. But the subscription agreement, therefore, specifies that underwriting commission. How much of the upfront sale value, the issue price of the bonds, will be held for the underwriters as their underwriting commissions. Very importantly, the subscription agreement also pinpoints, lays down that all underwriters signing that subscription agreement are liable jointly and severally to ensure that the bonds are sold, and if they are not sold, that they will buy them, i.e. those which are not sold. The importance of saying the obligation is joint and several is this. The issuer has a right to ask any one of the members of the underwriting syndicate to take up and pay for all of the underwriting unsold bonds. That's fundamentally different from what you see in a syndicated loan. If you remember, in a syndicated loan, the banks are obligated to lend only that amount which they have agreed to lend. If one of the banks fails to lend, other banks have no obligation to make up the difference. That's not what happens in a bond issue. If the bonds are not sold, let's say 20% of the bonds remain unsold on closing date, the issuer has a right to demand under the subscription agreement for any of the underwriters to take up and pay for that unsold 20%. It's not something that it is only allowed to do to ask all of the underwriters. It can ask any one underwriter to do it. Now in practice, you can work out commercially what happens. If the bond issue is a not a total success, and there's 20% unsold bonds, in practice, although the issuer would have the unqualified legal right to ask any one of the banks underwriting to take up and pay for the issue, in practice they would turn to the lead manager, with the lead manager who would take up and pay for those unsold bonds. Right, okay, that's the guts of the subscription agreement, but there's a whole number of clauses which go into support that underwriting obligation, which is triggered on closing date. Therefore, the subscription agreement protects the position of the underwriters by a series of conditions precedent which are included in the subscription agreement, which must be satisfied before the underwriting obligation is triggered on closing date. These have got to be satisfied. And they include reasonably obvious things like legal opinions from jurisdictions that are relevant to the bond issue, including obviously the issuer's jurisdiction. Then there are representations and warranties concerning the accuracy of the financial statements of the issuer which have been delivered to the underwriting banks. A representation and warranty that accuracy and completeness of the offering circular. Don't forget two things, accuracy and completeness, not simply accuracy, it's completeness as well, meaning all that should have been included should have been there. If not, the condition precedent is not satisfied. That all the agreements which the issuer is party to are valid under their governing law, and also that an agreement which the issuer is not party to, the agreement between managers, is valid and effective under the governing law. Next, that all central bank, exchange control, and similar authorizations and permissions, if they are applicable, have been obtained, and the relevant documentation submitted as conditions precedent documentation. The next one that's required is an auditor's comfort letter, as it's called. This is required under the ICMA rules. Remember what ICMA is? Uh-oh. What does it stand for? Somebody said something. Yeah. Yeah, exactly. That's ICMA, International Capital Markets Association. They lay down guidelines as to what needs to be done and needs to be done in relation to each bond issue. And ICMA suggests that they ought to get, that the underwriters should get, an auditor's comfort letter, and the form for it is found in the ICMA Appendix A2 to the ICMA guidelines. And also there is a director's responsibility letter which is usually required as a condition precedent, meaning directors taking responsibility for the accuracy and completeness of the offering circular. Once again, the format for that you'll see in the ICMA rules. The next point that needs to be remembered is, hang on, I'm going to jump a section, is that in addition to the conditions precedent protection for the lead manager and the underwriters in relation to the underwriting obligation, there is a power given to the lead manager to terminate the bond issue at any time before closing date, if any of these things that are mentioned in this clause happen. This clause is the most recent clause recommended by ICMA, and which is inevitably used by investment banks in the subscription agreement. So that's where you'll expect to find it, in the subscription agreement. Now, what it says is important to understand. First of all, it says, if in the opinion of the lead manager, somewhere down there, yeah, here, there shall have been such a change in national or international financial, political, or economic conditions, or currency exchange rates or exchange controls, any of those things. You can see how wide that is. Changes in national or international financial, political, or economic conditions. Well, we're going to have one on March 29th, I guess, or when the Prime Minister is flung out. So there will be a change of some sort, which will easily fall within the ICMA force majeure clause. And then, what should these changes in international, financial, political, or economic conditions do? They must, look at the yellow bit, likely to prejudice materially the success of the bond issue, the offering, and distribution of the securities. But even more importantly, not more importantly, equally importantly, dealings in the secondary markets of the bonds. So if any of these things is likely to affect not just the issue of the bonds in the primary markets, but could also potentially jeopardize trading of the bonds in the secondary markets. All right, let me stop for a second, brother. I can see the clouding coming over. What's the difference between the primary and secondary markets? And where is the primary market? Where is the secondary market? Yeah. Exactly. Any trading beyond that is the secondary market trading. Exactly. So what this clause is doing is saying, well, if any of these things change, national, international, financial, political, economic conditions, in a way that affects either the actual bond issue in the primary markets or trading in the secondary markets, there is a right to terminate the bond issue prior to closing date, or indeed on closing date. And the important bit here is in the opinion of the lead manager. Now, most law firms add in another word into this, in the sole opinion of the lead manager, to make it even clearer that you can't question it. Which means that, in effect, the lead manager has got a virtual ability to terminate the bond issue prior to closing date. Because all you've got to do is look for something national or international, financial, political, or economic conditions, and there's a change. Well, is the election of a new prime minister in Brazil a change in political circumstances in Brazil? Yes, it is. Is a vote happening in Parliament today a change in national, financial, and political conditions? Yes. Is Mr. Trump not being able to pass the finance bill in Congress in there? Yes. So theoretically, just about anything can fall within this. But then you ask the next question, when was the last time this clause was actually triggered by a lead manager? Answer, never. Not even after the 2008 financial crash. Not even that massive 2006 tsunami, which destroyed half of South and Southeast Asia. And if those of you who even remember hearing about this, the collapse of the European exchange rate mechanism, when countries like Denmark had to raise their interest rates to 800% overnight to keep their currency stable. This was years ago, prior to the introduction of the euro in year 2000. So it's a while back. Question, was this clause, or I can tell you the clause that existed then, it was very similar. That's the pre-2015 clause. Was it triggered by any lead manager? Answer, no. Now you've got to ask yourself, why do we have the clause then? The answer is yes, I think the lead manager would like to have that right, a kind of nuclear button once again. Never used so far, but that's not to say it won't be used, but it is virtually an insurance policy for the lead manager in order to pull, use a market word, to terminate the bond issue, if it so wishes to do it because of market turbulence. But the reason why it has not been used is that the Goldman Sachs, the Nomuras, the Deutsche Banks, and others, who are the lead managers in these global markets, are lead managers because of their global reputation to give a promise to an issuer saying, we'll sell your bonds, otherwise we'll bite ourselves, and keep to it. It's that reputation which is far more important than the legal jargon here. So yes, it's there, but never used because the reputation is far more important for a lead manager. So that's essentially what the guts of the subscription agreement is. There's not much else apart from the usual enumeration of commissions, who gets what, when, etc. The next one that we need to look at is the agreement between managers. Now, this is an agreement to which the issuer is not a party. I repeat, not a party. Only the underwriting banks sign this agreement. And the purpose of signing this agreement is this. It is the underwriting banks and the lead managers' decision to distribute the underwriting obligation in the event that it is triggered on closing date. In other words, each underwriter agrees to underwrite a particular amount of bonds. 20% of the bonds, 5% of the bonds, whatever the number is. But that's an arrangement, rights and obligations, as between the underwriting banks. It's nothing to do with the issuer. As far as the issuer is concerned, if the bond issue fails to 10% or 20%, it can call on the lead manager or any one of the underwriting banks to take up and pay for that entire lot. This distribution, which is occurring under the terms of the agreement between managers, is, as the term states, an agreement between the underwriters and nobody else. So if, for example, if you have a bond issue which fails up to 20% and is not sold by closing date, issuer calls on the lead manager to take up and pay for 20% of the bonds. The lead manager then falls back on the agreement between managers and the allocations contained in the underwriting obligations to enable it to say, okay, you agreed to take 10%, you agreed to take 20%, you agreed to take 30%, so now we're going to prorate the unsold bonds amongst the underwriters who signed the agreement between managers. And that's how the distribution will occur, through the legal mechanisms contained in the subscription agreement and the agreement between managers. The other thing that it achieves is to impose an obligation on all of the managers to comply with all applicable regulatory laws. And that's quite a major task, because you're talking about US regulatory law, EU regulatory law, Japanese regulatory law, Singaporean honkies, all the jurisdictions which are applicable. And that's an obligation which they must comply with, and if they fail to comply with it, another clause kicks in. Each underwriter agrees to indemnify every other underwriter for any loss suffered due to a breach by an underwriter of its obligation to comply with applicable regulatory laws. So if one of them breaches it, inevitably what might happen is that a regulator like the Securities and Exchange Commission in the US or the FSA in London will step in and take action, resulting in losses being suffered by the underwriters, in particular because they've stopped the issue. The best example you can think of is non-compliance with stabilization rules. Somebody goes and does something which is a breach of regulatory law on stabilization. We haven't come to it yet, which I'll go through in some detail, but if there is such a breach, then you have the bond issue being brought to a grinding halt usually by the SEC. And then you have losses being suffered by the underwriters, by the issuer, and everybody else. That indemnity, therefore, covers that loss resulting from non-compliance with applicable regulatory law by one or more of the underwriters. The next thing it deals with is stabilization. All managers agree in the agreement between managers not to engage in any stabilizing activity in the grey markets, and that all stabilizing activity can only be undertaken by the lead manager and nobody else. That clause, by the way, is mirrored, and I didn't mention it when I was talking through, where I left it at the bottom there, in the subscription agreement is also an identical stabilization clause saying no one but the lead manager may stabilize. And that obligation is contained in the subscription agreement so that it binds the issuer. It's also contained in the agreement between managers so that it binds everybody who's an underwriter as well. So that's the third objective of this agreement between managers. And then there are top-up things such as the right to terminate the subscription agreement under the ICMA force majeure clause. Now, if you look at the force majeure clause carefully, you'll see that, in fact, the right is the joint lead manager manages on behalf of the managers may by notice to the issuer terminate. It's a right which is with the underwriters, which the lead manager exercises on their behalf. That is as far as the issuer is concerned. Now let's see what happens in the agreement between managers. In the agreement between managers, that termination right is given without question, without qualification, without condition to the lead manager. In other words, the other members of the syndicate abrogate their right to control the lead manager's exercise of rights to terminate the subscription agreement under the ICMA force majeure clause. So although as between the issuer and you need to understand the contractual structure. As between the issuer and the underwriters have the right. As between the lead manager and the underwriters, the agreement between managers says, no, only the lead manager can do that. So there is a patchwork of contractual rights being created by these two agreements in the way they operate. And I think you need to try and understand how they interact. Next, it deals with default by any one of the managers. This is not about failing to comply with the regulatory law, but failing to comply with the obligations in the subscription agreement, in particular, if on closing date, one of the underwriters fails to take up and pay for unsold bonds in accordance with the allocations contained in the agreement between managers. That is default under the agreement between managers. What happens? Well, the lead manager is given a right in the agreement between managers that if one of the underwriters, usually called a manager, defaults in relation to its obligation to take up and pay for unsold bonds, the lead manager may prorate that amount of bonds amongst the other managers and underwriters. So let's take an example. If you got a bond issue which has failed up to 20%, lead manager then calls on different managers to take up and pay for allocations of bonds. Let's suppose somebody has agreed to do 20%, and that somebody fails to take up and pay for that 20% of the unsold bonds. What happens now? Lead manager has a right under the agreement between managers to call on the other underwriters and managers to take up and pay for the bonds which the defaulting manager has failed to take up and pay for. So that's the default management on closing date, which is also controlled by the agreement between managers. It then talks, once again, as usual, far more important to most investment bankers is fees and expenses. Exactly how much fees are going to be paid to each of the managers, which is based on the total amount which would be paid by the issuer under the subscription agreement to all of the underwriters. So there's a cascade. Issuer to managers under the subscription agreement, the payment coming from a deduction from the total amount of the bonds sold, and at that point, there is a fee distribution set out in the agreement between managers to decide who gets what in terms of the obligations to underwrite. Needless to say, those managers who agreed to underwrite a higher amount of bonds will get higher commissions, and those who have agreed to underwrite a smaller amount of bonds will get a lower commission. It's rather basic, but it's important that one understands this structure as it goes down. Now, when we're talking about this cascade of obligations, In the subscription agreement, issuer has a right to call on any one of the managers to take up and pay for unsold bonds. Usually, in practice, that will be the lead manager. Lead manager can fall back onto the agreement between managers to say, right, you guys are going to take up and pay for pro rata in relation to the amount you've agreed to underwrite the unsold bonds. Now, there's another agreement which is sometimes used called, hang on, yeah, I haven't actually got a, have I got a slide on it? No. Called, confusingly called, the underwriting agreement. It's actually a sub-underwriting agreement. It's rarely used, but it is used in mega bond offerings, i.e. 5 to 20 billion and upwards. That level of bond offering would usually attract not only a subscription agreement, an agreement between managers, but something called a sub-underwriting agreement. Now, what does this additional agreement, when it's used, actually achieve? What it does is that it agrees with another group of banks, independent of the managers in the main bond issue, that they will take up and pay for a percentage of the unsold bonds in the primary issue. So if you think about the cascade that's going to happen once you've got an sub-underwriting agreement, the issuer will trigger its rights under the subscription agreement to say, now, you, lead manager, take up and pay for the 20% of unsold bonds. Lead manager at that point has got an option. It can go directly to the agreement between managers and say, right, I'm calling on you guys to take up and pay for pro rata shares of the unsold bonds. Or it can go, if there is a sub-underwriting agreement, into the sub-underwriting agreement to take up and pay for the unsold bonds in accordance with the underwriting commitments undertaken by this independent group of investment banks, which are the sub-underwriting group. Now, in practice, if this happens, the lead manager will go immediately to that group, the sub-underwriting group, and ask them to take up and pay for 30% of the unsold bonds. So if 20% of bonds are unsold, 30% of that 20% will be required by the lead manager to be taken up and paid for by this sub-underwriting group. What is left will then be transferred by the lead manager to the main managing group of underwriters under the agreement between managers to say, now, under the agreement between managers, you will take up and pay for the bonds that have not been taken up by the sub-underwriting group. You see the cascade? Have a look at this diagram to see how it works. Issuer, under the subscription agreement, calls on the lead manager. Lead manager, under the sub-underwriting agreement, can call on these second group of underwriters, as it would usually do in practice. What remains will then be used by the lead manager, not used, would then be allocated under the agreement between managers to the other banks, investment banks, which are party to the agreement between managers. And that's how the cascade works. It's all about distribution of the risk of the failure of a bond issue. This is very rare, this sub-underwriting agreement. As I said, you're talking about the mega issues of 5 billion to 20 billion plus, where you might see the use of a sub-underwriting agreement. But there's not much to it other than the sub-underwriters, as usual, agreeing to comply with all applicable regulatory laws, to leave stabilization to the lead manager and not to do any kind of stabilization themselves. It's the usual clauses which are found in the subscription agreement, the agreement between managers, and also in the sub-underwriting agreement. They mirror each other. Any questions so far? Okay. The fourth document that we need to think about is the actual offering circular on that list of documents that are signed on signing date. That one. The what is called the red herring or draft offering circular, which is submitted to the stock exchange on which the bonds are to be listed. It's theoretically in draft form, but as far as the lawyers are concerned, as far as the investment bankers are concerned, it is virtually in final form. And as I said, that offering circular will be signed and submitted to the stock exchange on signing date. But it will not be effective until authorized and approved by the stock exchange. And that does not happen until closing date. Now, what is this offering circular and what's contained in it, which is really the question we've got to answer. The offering circular and the final prospectus are regulatory documents, not just marketing documents, because they are drafted in accordance with the regulations applicable in the stock exchange on which the bonds are to be listed. So it will be listed in Frankfurt or London or Paris or Tokyo or Singapore or Hong Kong. No, not in New York, and I'll tell you the reason why shortly. It's to do with United States securities laws. Most international bond issues are actually listed outside the US. So, what is the law that's applicable to this offering circular stroke prospectus? Answer, since most international bond issues, except for those to be listed in Shanghai, Hong Kong, or Singapore, Tokyo, are listed in the EU, the most important regulatory law in relation to the offering circular or the prospectus is EU regulatory law. Theoretically, whether you list in London, whether you list in Frankfurt, Paris, Milan, or wherever, the same rules must apply, will apply. And that is controlled by the EU's prospectus regulation of 2016. Consequently, I'm not going to talk about the offering circular now and what's in it and what should be in it. I will deal with it when I come to talk about regulatory law in the coming weeks, because I just need to go through what does the EU prospectus regulation require to be included in the prospectus and offering circular. So I'll deal with that at that point in time. I mention it only at this stage to mention that it is the third of the documents which is readied on signing date. On closing date, as I said to you, hang on, have I got the diagram again? Yeah. On closing date, that prospectus becomes effective on the stock exchange. It's now in absolute final form, and it becomes effective as an approved document for listing purposes. On the same date, closing date, something else is signed off, the global bond, reflecting all of the bonds sold in the bond issue. If there are definitives, they would also be printed and made available on closing date. So what we need to do next is to start looking actually at the bond instrument itself. What does it contain? Now remember, the subscription agreement, the agreement between managers, and the sub-underwriting agreement, when it's used, are marketing documents. They are live and effective until closing date. On closing date, all of the obligations and arrangements contained in those documents fall away. They do not have any further function. What remains thereafter is the relationship between the issuer and bond investors. That relationship is at least partially based on the actual terms of the bond instrument. Where is it found? As I said, it's found as an appendix to the subscription agreement. It's also found as an appendix in the prospectus, i.e. what are the terms of the bonds. They are all set out in detail in the prospectus. But what is binding is that in the subscription agreement, because that's the quote-unquote terms and conditions of the bond instrument. So let's try and now look at the terms and conditions of the bond instrument. So, okay. Terms and conditions of the bond instrument. Where do you find them? In the bond instrument, at the back of the subscription agreement, and in the prospectus. So, The obligations are, the straightforward ones are easy to understand. Obligation on the part of the issuer to pay interest on a 6-monthly or 3-monthly basis, whichever the investment banks have decided, and to pay back the principal in the currency of the bond, the currency of issue. That's the first and most important obligation. Next, there is the repayment clause, which deals with the requirement to repay on scheduled dates or in accordance with a schedule or other mechanism. But remember, the repayment occurs at face value of the bond. The issue of the bond, if you remember, will be at issue price, which is not the same as face value or repayment or redemption value. Okay? But it will have a repayment clause, which would also in practice include early redemption provisions, i.e. circumstances in which the bonds can be redeemed prior to final maturity date. And the inevitable withholding tax clause, there's nothing new there, you already know it. It's exactly the same clause that you've seen in a syndicated loan agreement. There's a negative pledge clause, which again you're familiar with, and I'm not going to walk you through all of that. But suffice it to say at this point in time that the negative pledge clause is a lot more loose than the one you see in syndicated loan agreements. A lot more flexible. The pari passu covenant, again, which you've come across, again, something that you'll find both in syndicated loans and bonds. Let's now look in detail at these provisions up here that are found in the bond instrument, starting with the obligation to make payment of interest and principal in the currency of the bond. Now, in terms of interest rates, the interest rate clause varies from bond to bond. As you have probably gathered, most international bonds are issued on a fixed rate basis. Carry the fixed interest rate payable in the currency of the bond and it payable 3 or 6 monthly, depending on what's the term included in the bond instrument. That's a standard fixed rate bond. There are also bonds where the interest rate clause is actually similar to the syndicated loans interest rate clause, meaning the payable interest rate is a floating rate pegged to LIBOR. So once again, you'll have a LIBOR rate which affects what interest the bond investors are getting, calculated on the basis of 3-monthly or 6-monthly LIBOR as specified in the bond instrument. Now, you don't go through that whole rigmarole that you have in syndicated loans where the borrower comes in and says, can I please get an interest rate fix? The agent bank then goes out, gets an interest rate fix, transmits it to the borrower, all of that? No, it doesn't happen. All that happens is the clause says, borrower shall pay an interest rate of percentage calculated by reference to LIBOR plus a margin, whatever the margin is, on a 6-monthly basis. The LIBOR rate of interest payable on the basis of 6-month LIBOR, if that's the payment rate that is actually specified. They're called FRNs because they're floating rate notes. The third type of interest rate clause is a clause whereby the issuer agrees to pay a LIBOR rate to bond investors or bond purchasers. However, if the LIBOR rate in the markets falls below a threshold level, usually around 3% or lower, then the bond stops being a bond which is required to pay interest on the basis of LIBOR, but converts into a fixed rate bond at that threshold level. In other words, from now on, bond investors will be paid that floor level of interest. They will not be subjected to the falling LIBOR rates in the markets. That looks good until you realize that the clause also makes it very clear that once the interest rate locks at the threshold floor level, it doesn't change for the rest of the life of the bond. So if interest rates, LIBOR interest rates rise in the markets, it doesn't unlock itself. It remains locked at that threshold level, and bond investors will be paid that threshold floor level until the end of the term of the bond. And that's why the markets call it a drop lock bond. Interest rate drop, the bond has a floor level at which it locks interest rates at that level, and then it stops there. It keeps at that level for forever and a day until the bond is repaid. The next variation on the interest rate clause is the zero coupon bond. This is a bond where the interest rate clause says the issuer shall not be obliged to pay any interest on the bonds at any time. And you think, why the heck is anybody buying this stuff if no interest is payable and is paid on this bond? The answer is that if it's a zero coupon bond, the issue price of the zero coupon bond will be at a deep discount, meaning the issue price will be 20% of face value, 25% of face value, that low. How do they calculate at what level the bond has got to be issued? The issue price is, investment bankers say, very easy, because you look at the interest rate that's available in the markets, you look at the life of the bond and work out how much interest an investor should get, and instead of that interest being paid on an ongoing basis as in the ordinary bond, that interest is given to the buyer of the bond up front because of the deep discount. You can buy the bond with 100% face value at 20% of face value. So the investor gets that up front, the interest that would have been paid over the life of the bond. So it has got that advantage. And what happens in the markets in relation to such a zero coupon bond is that the value of the bond rises and goes on rising nearly to 100% until the date on which the bond is to be redeemed. So there's a rise in the value as it nears redemption date. Why? Because redemption is at 100% of face value. So to that extent, although issued at a deep discount, and the interest rate clause says no interest shall be paid, on redemption date it reaches full face value of 100%, and an investor will get that 100%. One reason for this zero coupon structure is the tax laws in many jurisdictions. Not in Europe or in the US, but in some jurisdictions. In the US and in this country, and in the EU, which I think most countries in the EU, if a bond pays interest, that interest is taxable in the hands of the investor. Normal rule. However, if the bond is a deep discount bond and a zero coupon, there is no interest to be taxed. The only basis of taxation is the rise in value of the bond nearing its redemption date. What you can tax, therefore, is the rise in value of the capital of the bond. Now, that is usually taxed under capital gains tax rules, where the rates in many countries is a lot lower than the income tax rate. There lies the reason for the issue of the zero coupon. You can't play that game in the EU or the US, because in the EU and the US, the tax rule is very simple. Even if it's a zero coupon bond, the tax authorities will say the effective interest rate payable on this bond is so much, and you will pay that. You will pay the tax based on that deemed interest rate payable to the investor, which makes a zero coupon bond virtually of no use if you're issuing it to European investors. But there are still jurisdictions where you can effectively use the zero coupon structure to give the investor a lower tax rate than the income tax rate in those countries. Okay. It's not regularly seen in the markets because of that, because the EU authorities and the US clamped down on the use of zero coupons to avoid tax. Next, there are two types of floating rate notes. The RRNs, otherwise rolling rate notes, and VRNs, variable rate notes. They're both floating rate notes like this category here, but the way the interest is calculated and the interest rate clause is different. In the RRN, the interest rate clause says issuer shall pay interest at the rate of LIBOR plus X and shall pay it on a 6-monthly basis. But here's where the clause then changes. The actual interest payable is not paid to the investor immediately, but is paid, say, once a year. The interest calculated for the first 3 months or the first 6 months, which is payable, is then added to the capital of the bond, i.e. the capital value of the bond. And interest is paid on that amount at the end of the year. It's just an interest rate calculation. What you do, in other words, you roll in the interest due and payable into the capital value of the note, and the issuer is required to pay an interest rate calculated not only on the face value of the bond, but the additional interest which is accrued for the first 6 months and onwards, which gives an investor a better return. So the interest rate clause will simply refer to interest payable at LIBOR plus, but not paid until whatever the date is, 1 year from now. And at the end of that 1 year period, the interest accumulated for that year will be rolled up into the capital of the bond, and the interest rate payable at the end of the year shall be based not just on the face value of the bond, but the rolled up interest. That's why it's called a rolling rate note, because of this interest rate clause. Variable rate notes are also notes which pay out on a floating rate basis, but the difference is this. Both FRNs and RRNs, the interest rate clause locks into LIBOR, i.e. it's based on a LIBOR rate. A variable rate note not only refers to LIBOR, but the amount of interest payable is also made dependent on something else. Example, if the dollar-euro rate is above 2 to 1, the investor will have a higher rate of return than LIBOR plus 0.5%. So there's an added element of interest, which is, or return, I should use the word, to the interest payable by reference to LIBOR. So the actual interest payable varies, not just dependent on LIBOR, but some other factor. Or if gold is at above 2,000, or gold is above 1,500, the issuer will get X or Y. Not the issuer, I'm sorry, the bond investor. So you have an interest rate clause which actually brings into play factors other than LIBOR to produce a variable rate of interest. Okay, that's the interest rate bit. Let me come to the redemption provisions. And here there's another level of variation in terms of how bonds are redeemed at the end of the life of the bonds. Most bonds usually have a single maturity date when all of the face value of the bonds need to be repaid. In the markets, they call it a bullet repayment clause. But there's a whole number of alternative provisions in bond instruments which actually provide for different forms of redemption. In particular, there are those bonds where the redemption of the face value of the bonds is subject to repayment in installments or according to a schedule prior to redemption date. The two most common forms are these. in practice. Bonds with sinking funds and bonds with purchase funds. So let's start with those. Basically, bonds with a purchase fund and a sinking fund result in the redemption of the bonds during a stated period in the bond instrument, say 5 years after maturity or 7 years after maturity, up to a stated percentage of the total amount of the bonds issued. So the clause might read that 30% of the bonds issued shall be redeemed in year 5. 10% shall be redeemed in year 7. Another 10% in year 8, and all of it that remains redeemed on maturity. It's an installment repayment schedule, in other words. Now, there are two forms of structure for that kind of installment redemption. The commonest one is the purchase fund, whereby there's a schedule of installments which sets out how much, what percentage an issuer must redeem and in what year. Year 5, year 6, year 8, year 10, year 15, whatever the number is. And a percentage must be redeemed at that time. Now, the obvious question that must cross your mind is, how do you know whose bonds are being redeemed? Supposing it's 30% in year 7. Well, how do you know what has been redeemed? Whose bonds are going to be redeemed? Well, the answer is that the structure locks into mechanisms contained in Euroclear Clearstream, where 30% of bonds have got to be redeemed in year 7, for example, fiat bonds due 2030 to be redeemed in year 7. Euroclear Clearstream are given an instruction to draw lots on the 30% to be redeemed and allocate it, allot that 30% by lot to the account holders in the clearance system who have got fiat bonds due 2030. So it's like a lottery system, which Euroclear and Clearstream are required to operate. Yeah. Good question. Good question. If you remember, the structure of account holding is that account holders in Tier 1, having accounts in Euroclear, Clearstream, or DTC, if they sell bonds out of their proprietary account to a second-tier investor, will move those bonds into a client account. And investors down the chain will keep on allocating into client accounts if they sell some and keep some. Now, on an allocation of redemption under a purchase fund, Euroclear and Clearstream will say, right, Morgan Stanley, you have X million dollars of bonds. We are allocating X million to be redeemed along with the following banks up to 30% of face value. Now, at that point, Morgan Stanley has the ability to either redeem its own bonds or redeem those of its clients. And that's essentially how it works. If the client redemption is chosen, then inevitably that means it will inform its buyer, who will inform its buyer, who will inform its buyer, and so on. Those bonds have been redeemed to a tune of 5 million or 10 million or whatever the number is. And that's how the system works in a purchase fund. Sorry, God, I'm going crazy. Sinking fund. The alternative method is the purchase fund. In a purchase fund, the clause reads as follows. Did I say purchase fund earlier? I'm going completely mad. Sorry, all that I've said up to now is about the sinking fund structure. Can you please make a note of that? I'm sorry. That's the sinking fund structure, not the purchase fund structure. I'm sorry. The purchase fund structure operates differently. The purchase fund structure requires the issuer not to redeem bonds of 30% in year 5 and 10% in year 7 and so on, but to offer to purchase in the markets a specified percentage of the bonds in year 5, year 6, year 7, year 8. And for that objective, to appoint a specific purchase agent who's authorized on behalf of the issuer to go into the markets and make an offer to buy And the obligation to make an offer to buy is an obligation to make an offer to buy at market price, the then prevailing market price, on the day on which the offer is made to the markets. Now, note the difference. In a sinking fund structure, the redemption is at face value, not at market price. And that sometimes works unfairly, because you could be holding a bond which is now trading at 105% of face value in the markets, and then suddenly it's caught by a redemption clause and it's redeemed at 100% of face value. You lost 5%. So in that sense, sinking funds are not very favored by investors. They'd rather see a purchase fund structure. Now, in that purchase fund structure, as I said, the obligation of the issuer under the bond instrument provisions is to make an offer to the markets to buy up to 30% of bonds. Now, a question that needs to be asked is, what happens if nobody accepts the offer, even though it's at market price? Answer: the issuer has complied with its obligations under the bond instrument, or only 20% of bond purchasers offer to redeem their bonds in response to the purchase offer. Answer: once again, the issuer has complied. In other words, its obligation is not to redeem the 30% of the bonds, but to make an offer to the markets to redeem 30% of the bonds in year 5 and maybe 10% in the year after, and so on. So it's a different structure altogether, and investors favor this structure for obvious reasons, because it means that whatever the price is in the markets, that's what they're going to get for their bond. So that's the sinking fund and the purchase funds. Then we've got another one. I'm going to go in a slightly different order to the slide. Things called serial notes. This is a hangover from days gone by. In both these structures, sinking fund and purchase fund, when you say 30% of bonds outstanding are to be redeemed, the bonds that are being redeemed are separate and independent bonds. When redeemed, amounting in total to 30% of the total outstanding value of the bonds. In a serial note structure, the obligation of the issuer is to redeem at specified dates a specified percentage of each bond. So, year 5, 30% must be redeemed of each bond. So everybody who has got an account in which it has bonds of Fiat 2040 bonds will have its bond holding redeemed, each bond, by 30%, leaving each bond investor only with 70% of the value of the bond, the outstanding face value of the bonds. That's a different structure. It reduces by redemption not some bonds, but each bond to a percentage specified in the bond instrument. These are all different ways of doing the same thing. But most investors regard this one as, in a way, fairer than any of these, because it treats all bondholders, in a sense, equally. Why is it called serial notes? That's why I said it goes back in time. In the good old days, meaning good old days is about 25 years ago, no more. That's old in terms of the bond markets. When a serial note bond was issued and redemption was to be made of each bond for a certain percentage of that bond at specified dates, what happened was definitives were issued, piece of paper, where it had strips which could be torn from the bond. So if 30% had to be redeemed, there was a little strip representing 30%, and then another strip representing 10%, redeemable in year 7, and so on. I mean, obviously that doesn't happen anymore. Nobody tears off bits of paper. But the name has survived. It's still called serial notes when you adopt this structure where all bonds of a particular issuer are redeemed to a percentage of each bond at specified times. Okay, the next type of redemption clause are bonds with call options and put options. Yeah, those who are doing derivatives are quite familiar with this stuff, I guess. But yes, it is actually very much a derivative structure embedded in the bond. But let's not worry about that. You can forget about the derivative bit because this is rather straightforward. A bond with a call option contains a redemption clause which says the issuer is given a right, not a duty or an obligation, to redeem up to 30% of bonds in year 5, 10% in year 6, and 10% in year 7, and so on and so forth. It's an option to redeem up to that specified amount. The issuer can decide not to exercise it and not redeem that amount, leaving it to redeem everything on the termination date of the bond. But it has a right. That's why it's an option. It can exercise it, and if it exercises the option, then the bonds will be redeemed to 30% of the totality of the bonds. A put option, on the other hand, is a right not given to the issuer, but given to bond investors. As the name implies, it's an option, a right, which the bond investor has to sell back the bond and have it redeemed at face value to the issuer. 30% in year 7, year 5, 10% in year 6, 10% in year 7, and so on and so forth. But this time it is the investor's right. It makes the decision. These things are important to people in the markets because if you've got a call option, it means that if the bond is trading at 110% of face value, the last thing you want is for the issuer to say, well, I've decided to call 30% of the bonds. I got a call option. What happens? The investors lose money because market value 110 is being redeemed at 100. Same problem as with the sinking fund structure. But a put option is different. It's the investor's choice. And an investor is not going to sell at face value, exercising his right to sell the bonds to the issuer. If the bond is trading at 110, it will exercise its put option if the bond is trading below 100% of face value. So it gives an investor an additional advantage, an additional incentive to buy a bond with a put option embedded in it rather than a call option. Yeah? No, you're absolutely right in raising that question. It's the issuer's right to redeem the bonds up to 30% of the value of the total outstanding bonds. Investors do not have a right to say, no, sorry, I'm not selling. Okay, so those are the basic formats of redemption. There are other clauses which are sometimes included which have an impact on redemption. Let's start with these, extendables and retractables. A bond with an extendable provision in redemption will state that the issuer has a right, again, issuer's right, to extend the life of the bond beyond the final redemption date specified in the bond, up to a maximum of, say, 3 years or 5 years at the issuer's option. So it has an option to extend the life of the bond for, say, 2 years at its option and not have to repay on actual redemption date. That's an extendable. It's simply a clause which enables the issuer, gives the issuer right to extend the life of the bond for an additional period of time, usually 1 or 2 years or sometimes 3 years. It's an extendable. Yeah? Would it be? Absolutely. Absolutely. The bond terms in every way continue until it's simply a right to extend the life of the bond. That's all it is. And the retractable is the exact opposite. If a bond contains a retractability clause, it means that the issuer has a right to bring forward the redemption date up to a maximum of 2 years or 3 years or whatever the number is. So if you've got a redemption date of 2040 and you've got a retractable provision in the bond instrument, it will provide that the issuer may redeem the bonds by shortening the life period of the bonds from 2040 to 2035. It's not something, as you can imagine, popular with investors, because retraction means that one, the bond can be redeemed prior to maturity, and that means you lose interest for 5 years or 3 years or 4 years. And what's worse, if the bond is retracted to a point in time when the bond is trading at a point where it's trading at a higher market value than face value, you're suddenly caught with the same problem, redemption at face value. So to that extent, it's not something that bond investors are particularly happy with, but retractability clauses are there because it gives an issuer the right to repay a bond when it suits the issuer rather than anybody else. So it can shorten the life of the bond and pay early, in other words. Essentially, that's a retractable. Right. Now I'm going to talk about a curiosity, the perpetual bond. It's a bond with no maturity date. It's perpetual. It simply says issuer shall pay interest at such and such a rate, and there is no redemption clause. The only time at which the bond will be repaid is on default. Absent a default, it will continue to eternity. And the issuer will simply continue paying interest at the specified interest rate in the bond. Now, these are a curiosity because they were put together for a particular reason to do with banking regulations. And I'm going to spend 2 minutes just explaining what that is and why these bonds became popular and then fell out of favor. Banks in the developed economies, whether EU, US, Hong Kong, wherever, China, Japan, are subject to Basel regulations. The Basel regulations, without going in any detail into it, you don't need to, require banks to maintain capital, i.e. share capital and profits, to a certain ratio to support what are called risk-weighted assets on the balance sheet, i.e. loans which are not particularly going to be safe in the long term. Risk-weighted assets to capital. So if you end up with, what are your assets, by the way? Loans that you're making. That's what the asset of a bank happens to be. So if you made a huge amount of loans and suddenly the economy turns in the countries where the borrower is located, and the risk weighting of the loan assets becomes higher, rated by the central banks, you'd be required, you the bank which has got those loans, will be required to raise more capital in order to support those risk-weighted loans, which means your share capital has got to be increased. Why is that a disadvantage? Raising share capital is a hugely expensive business. It also dilutes the share capital that you've got on your balance sheet, annoys your other investors, i.e. shareholders, and so on and so forth. Not something that banks like to do. Because of that, banks went to central banks and said, listen, we've got a new idea. We won't issue shares because they're expensive and costly. Can we issue bonds which are never going to be repaid? And will you take that into account in calculating our capital ratios, i.e. the amount of perpetual bonds issued by a bank is added to the share capital of that bank when the Basel risk asset calculations are made. So if you've got risk-weighted assets, to support it, you've got share capital, and then if central banks agree, they've got perpetual bonds which can be added in. And central banks originally said, yeah, that sounds fine. And guess what? The market was flooded with perpetual bonds, all issued by banks. They had two major advantages. One, they were a lot cheaper than share capital to raise. They had the same effect as share capital in relation to supporting risk-weighted assets on the balance sheet. And then there was another big advantage. Perpetual bonds do pay interest. So if you are a bank issuing a perpetual bond, the interest that you'll pay your bond investors is beautifully tax deductible. Why is that important? Because if you had to raise your funding by share capital and you had to pay dividends, those dividends are not tax deductible. They are paid, dividends are paid after tax, not before tax. Therefore, the perpetual bond had a huge advantage in terms of its attractiveness, both to investors on the one side and also to the banks. More to the banks, I guess, in terms of attractiveness. So what happened? Some 5 years later, the Bank for International Settlements, which is the global monitor of the banking system, did an analysis of perpetual bonds. Yes, they were all issued by banks because the advantage was to a bank subject to Basel capital ratio calculations. But what was even more interesting was that 90% of perpetual bonds were bought by whom? By other banks. So that the whole edifice now rested on very shaky foundations because you were giving risk-weighted capital advantages to banks based on what? On perpetual bonds issued to other banks. So the whole system, in a way, was not made more stable by the issue of perpetual bonds as distinct from shares. So central banks began discouraging the issue of perpetual bonds, saying, no, we're not going to treat them as being equal to shares. We'll give them a much, much lower value in terms of risk-weighted asset calculations. Result, perpetual bonds, I shouldn't say went away, but they fell out of favor. But they are there in the markets. There are a huge number of perpetual bonds still outstanding in the markets because they have no redemption date. Flip-flops are perpetual bonds which have an additional feature to them. This is a perpetual bond which is issued with no maturity date, just like the normal perpetual. But during a window of time, during, say, years 5, 6, and 7, or years 15 to 20, the issuer was given a right to convert the perpetual bond into a bond with a redemption date, if it so wished. So that was clause 1, which said you may convert the perpetual bond into a bond with a redemption date by exercising your right under this clause. And the next clause said, having exercised that right to convert the perpetual bond during this period of time, this window of time, into a bond with a maturity date, you may, prior to maturity, reconvert that bond into a perpetual bond. I.e., it goes from perpetual to one with a redemption date, and at the issuer's option, reconvert into perpetual bond at a later point in time. All of this had a lot to do with how the central banks were treating perpetual bonds. Thus, it was called a flip-flop, i.e., it went both ways. It started as a perpetual, became a bond with a redemption date due to a clause which gave the issuer the right to convert it into a bond with a redemption date and then reconvert back into a perpetual, if it so wished. And so the markets termed them flip-flops. Again, with the fall in popularity of perpetual bonds, so did flip-flops. Okay, so that's a run through the interest rate provisions and the redemption provisions which are contained in the bond instrument. And I'm going to touch very briefly on special terms in some bond instruments. And the reason I say special terms, I'm going to deal with it very briefly, is because I'm going to have an entire section on equity convertible bonds. But for the moment, I'm just going to say what they are, and then we can look at them in detail later. Equity convertibles are bonds which have a clause which gives the bond investor the right to convert the bond into the underlying equity of the issuer at a rate specified in the bond. Usually, this meant a double conversion because the bonds were usually issued denominated in euros, dollars, yen, and so on. Whereas the underlying share capital could be in another currency. It could be a euro-denominated bond where the issuer is a yen-denominated issuer. Consequently, when a bond investor was given the right to convert a $10,000 bond into the underlying yen-denominated equity of the issuer, you had to have a number of clauses which enable that conversion from dollars into yen and then from yen into the share capital. We'll talk about those in detail in a couple of weeks. A similar instrument is the bond with equity warrants. This is a bond which doesn't have any special clauses in it like an equity convertible, but it is issued with an additional financial instrument attached to it called a warrant. It's a bond with a warrant. What does the warrant do? It contains a provision which enables the buyer of the bond with the warrant to buy shares in the issuer of the bond at a price specified in the warrant. What's the difference here? Well, you've got to produce new cash to buy the new shares in the case of a bond with an equity warrant. In the case of an equity convertible, you didn't have to produce any new cash. You simply used the face value of the bond to convert that value back into the equity of the issuer, back into the share capital of the issuer. Those are equity convertibles and bonds with warrants. They have a huge amount of lawyering to be done to make them work and be effective, so we'll spend at least a lecture on those. Excuse me. A similar category are commodity-linked bonds. These are quite, I would say, not very common, but reasonably common. Essentially, these are bonds which have clauses which link the payment due to an investor on redemption of the bond at the end of the life of the bond to the value of a specified commodity. So you could have gold-linked bonds, you could have oil-linked bonds, well, any commodity that is actually traded in the markets. What does the clause actually say? It says that on redemption, the investor would have a right to either receive an amount, which is the face value of the bond, or to receive the market value of a specified amount of a given commodity, gold, oil, whatever. So in other words, the issuer has the investor ends up with a nice option. If the market price of oil has gone up, or the gold has gone up, such that the value of the quantity specified in the bond instrument is more valuable than the $10,000 face value of the bond, well, of course you're going to say, please let me have the gold. But obviously the clause doesn't let the issuer on the hook to start running around looking for gold. What it does is to say, if the issuer exercises the option to receive the value of the gold, then the issuer has an obligation to pay only the market value of the gold rather than the redemption value on the face of the bond. It has no obligation to deliver that amount of gold or oil or whatever the commodity is that's tied to the bond. I'm not going to say anything more than that because that's about all that you need to know. It's simply a redemption clause, in other words, which links the redemption value of the bond to a stated commodity such as gold or oil. They're the two most common that are used in the market, gold and oil. The last thing I'm going to mention are exchangeables, which are bonds which have a clause which enables the investor at a given point in time in the life of the bond, say year 5 to year 10, to exchange the bond at its option, at the investor's option, for another instrument specified in the bond instrument, which could be another bond, it could be a share, it could be something else. It's a right to exchange the bond for something else. Once again, it's an incentive for bond investors to buy that bond in the hope that the market value of whatever it is that is specified in exchange is going to be more valuable than the face value of the actual bond that the investor has purchased. All incentives to investors to keep buying the bonds which are linked to such exchanges or to such commodities which give the investor a greater incentive to buy the bond. As I said, I think I'm going to be talking quite a lot about the first two, the equity convertibles and bonds with warrants, because they do have a whole new structure and a whole set of clauses which deal with the special position of equity convertibles and equity warrants. Okay. Let me see whether... Okay, I'll just deal with this quickly and then we'll finish, okay? I don't think I want to get into anything else. Hang on. Okay. Withholding tax clause. Next one. As I said, nothing different to the standard withholding tax clause in a syndicated loan agreement. All right, someone tell me what it says. What does your standard withholding tax clause say in a syndicated loan agreement? Hello, anybody home? Anyone remembers what withholding tax is? Never mind the withholding tax clause. Yeah.
If the investor has to pay some kind of tax on the returns, then the clause says that
Not the investor.
the issuer has to pay.
It's the issuer. Just like a borrower in a syndicated loan, what the clause says is if the issuer becomes subject to a withhold imposed by the tax authorities of the country of incorporation of the issuer in relation to any interest payments due to an investor, then the issuer must gross up that amount of withhold and pay to the investor the full interest due on the bond, ongoing. If the issuer does not wish to do that, just like in a syndicated loan, the issuer has got an option to redeem the bond at face value at that point in time. That's the withholding tax gross up clause. Like I said to you guys, you need to go back and get on top of what we've covered, because this stuff is going to seep through into bonds, and from bonds in those who are doing finance 3, it'll seep in there. It's all over the place. This is an integrated market, integrated modules. I keep on saying this, but I don't think anybody takes me seriously. Next one down, negative pledge covenant. Now, the negative pledge covenant in a bond issue usually requires the issuer not to create or permit to subsist any security interest, including pledges, hypothecations, mortgages, blah, blah, blah. Subject to exceptions and a cap, obviously, as usual. but this time in relation to any indebtedness of the issuer. And sometimes that word is qualified by another word, indebtedness which is public. Now, if you have the latter form of the clause, public indebtedness, shall not create or permit to subsist security interest in relation to public indebtedness, that's the most favorable form for an issuer. What does public indebtedness mean? It means, as defined in the bond instrument, public indebtedness means in relation to bonds which are listed on a stock exchange. So security interest granted in relation to syndicated loans, in relation to any other project financing, in relation to anything else isn't caught by this clause. It's a much looser clause than the one you've seen. The slightly stronger clause doesn't refer to public indebtedness, it simply refers to indebtedness. And usually indebtedness, which means debts owed to banks and other financial institutions. And that's as far as it goes. It doesn't go beyond to catch the kind of provision that, that you saw in syndicated loans. There's the usual pari passu covenant, which you also saw in syndicated loans, i.e. the obligation not to grant any kind of preference to other unsecured creditors in relation to investors in the bonds, because they are always going to be unsecured investors. There is actually a case in this area concerning Argentina, and I thought I'd just walk you through it, where the pari passu covenant was reviewed by the New York courts in relation to the pari passu clause in the bonds governed by New York law and made out to Argentina. This actually involved the rescheduling of Argentina's defaulted bonds. It's quite a large amount, 15 billion of defaulted bonds. What Argentina wanted to do was to agree the rescheduling of the debt with a reduction of the face value of the bonds when repaid. And it entered into an agreement with some of its bondholders who were prepared to accept 60% or 40% of the face value of the Argentina bonds. There were hedge funds, Elliott Capital and Aurelius Capital, which had invested in the Argentine bonds after they defaulted, because that's what vulture funds do, vulture hedge funds. They wait for a default and they buy the bonds, because they are obviously trading in the markets at a very deep discount. Anyway, they were holding quite a large amount of these bonds. It was 1.3 billion, I've got to figure it out. And the vulture funds, Elliott Capital and Aurelius Capital, said, no, we are not prepared to negotiate with you for 40% of face value or 60% of face value. We want full face value for the bonds we hold. Argentina refused and then went on to pay some of the bondholders who had agreed to accept 60% or 40% of face value. Aurelius Capital and Elliott Capital immediately went to the New York courts and demanded that the funds so paid by Argentina should be frozen in the bank accounts into which they were paid, because they were made in breach of the pari passu covenant, the standard pari passu covenant contained in the Argentina bonds. And the New York court said that's absolutely right. That is a breach of the pari passu covenant for Argentina to have done a deal with some of the investors and paid them and not paid others. And that would be a breach of the pari passu covenant, and they froze the funds and held it until Argentina was prepared to pay the full face value of the bonds to the vulture funds. So it's a very good example of how the clause actually works. And in particular, it was in the context of rescheduling when this kind of thing happens all the time, where a borrower indeed, or an issuer in a bond issue, or a borrower in a syndicated loan, is trying to do deals with some of its creditors and not others. It happens all the time. Okay, so that's the pari passu covenant. There's also, you'd expect to see an anti-merger covenant. You're familiar with that. It's exactly the same as the syndicated loans agreement covenant, the anti-merger covenant. But apart from that, there aren't many other covenants. You don't expect to see, in particular, financial ratio covenants, which are invariable in syndicated loans. There are, however, some types of bond issues where financial ratio covenants are common, and they are referred to as high-yield bonds. The high-yield bonds I'll come to again as a separate topic later. Like equity convertibles, I'll do a section on high-yield bonds. But you'd expect to see financial ratio covenants in high-yield bond structures. I'll come to at a later time. What you do find, however, in every bond instrument is not a financial ratio covenant, but a downgrade clause. Exactly like the one you see in a syndicated loan. Okay, now wake up and tell me what a downgrade clause is. Yeah, please do. Yeah, go ahead. It won't be the syndicated loan which will be downgraded. The only thing that's downgraded is listed debt. So what the clause says, if one of the rating agencies downgrades the bonds of the issuer by usually 2 notches or 3 notches, 3 grades or 2 grades, then that constitutes an event of default under the bond instrument. That formula, as you remember, is also used in syndicated loans. It says if the borrower's public debt is downgraded, i.e. bonds are downgraded by rating agencies, then there is a default under the syndicated loan agreement. So they're exactly the same clause that you're looking at. 2 other covenants which you're familiar with, or hopefully familiar with, the asset disposal covenant and the merger control covenant, are generally not used in practice in bond issues. You might just pause for a second and say, why are these covenants a lot less stringent than those in syndicated loans? If anybody is awake and thinking, what do you think it is? Anybody? Oh, yeah, go ahead.
It's because in a syndicated loan, there's only a few banks, meanwhile in a bond issue, there's so many banks, it's quite difficult for all of them to bring a claim against the issuer.
Okay. Any other thoughts on the subject? Yeah. Makes it harder to trade with. Well, it'll be for the benefit of the investors. There's an asset disposal covenant, a merger control covenant. It'll be for the benefit of the investors, and investors are more likely to trade than less. Do you want to? Yeah, go ahead. Did you want to say something?
Yeah, my guess is because the banks know that they won't hold the bonds themselves, they will sell them on, so they are not sitting on the risk and don't have such a great need for controlling everything because they are selling it on to the investors anyway.
You're on the right track. Yeah.
I think that because the banks in the syndicated loan would have a portfolio of syndicated loans because both now the lender now not be as applicable here as bondholders do not buy bonds as what interest rate the lender is.
Okay. Let's just try and think this through a little bit, and that will kind of make you think about the differences in the structure of the 2 types of debt instruments. In a syndicated loan, first of all, the banks negotiating the covenants are the syndicate banks, right? Whose asset are they trying to protect when they negotiate the covenants? God, you must know the answer to that one. At least have a go. Raise your hand and say it's in the dog kennel, anything. Well, just think. Whose asset are they trying to protect? Their own, for goodness sake. They are the lenders, it's their loan asset which they're trying to protect with these covenants. Right? If the loan goes bad, their loss. The bank's loss, syndicate bank's loss. Now go into a bond issue. Who's negotiating the covenants which are included in the bond instrument? The banks are negotiating it, not the creditors. The creditors are the investors. They are not there at the table when the terms of the bond instrument are drafted. Secondly, I think this is the point Gianmarco made, it's not the asset of the investment banks which are involved in the bond issue. The asset is the asset of the investors in the bond. So the banks are negotiating the covenants, but the asset they are trying to protect is not theirs, it's those of the investors who are going to come in later into the picture. With the result, the banks have got a certain amount of leeway and flexibility in terms of what kind of covenants they would want to agree with the issuer. And obviously the lesser the covenants, the better, because they're more likely to get the mandate from the issuer, from the prospective issuer, if they say, look, we can do this bond issue with the following covenants. Forget the asset control covenant, forget the merger control covenant, we'll give you an easy negative pledge covenant. The next question you've got to ask yourself is, well, does that mean that the investment banks can simply get rid of all the covenants that you come across and not have anything at all? I'm trying to make you think, because this is how you understand this topic, by thinking about it, not reading about it. It ain't there in the books. Yeah. Exactly right. The level of covenant protection that investment banks agree with the issuer is dictated by whether the investment banks can sell and therefore satisfy their underwriting obligation, that there be enough investors to buy the bonds with the level of covenant protection contained in the bond instrument. How do they know that? That's their job, and that's why they are paid these commissions, because they talk to investors across the globe, and they know exactly what investors will accept by way of covenant protection, what kind of currency are they looking for, what kind of interest rate are they looking for, and so on and so forth. You're right. It is determined by the demands of investors out there. And the investment banks will bring in that knowledge in their negotiations with the issuer. But importantly, they aren't, as long as they know they can sell the bonds, they have nothing to worry about, because it's not their asset that they're trying to protect with these covenants. It's the investor's asset. Okay, good. At least I hope you got something out of that discussion, because it goes to the understanding of the differences in structure between a syndicated loan and a bond issue. Right, I'm not going to deal with anything else. I'm going to get on to events of default and cross default next week. Right, done.
Yes, sir. Hi. I live in the corner of Tuesday or this, and
Monday,
yeah, but I have finished dental table, and
Monday at 4.
yeah, and so on Tuesday at 6 I have this motivation. So right after
Wednesday, be good.
do you want me to